Welcome to The Explainer. Today, we're going to talk about how to stop stressing about your investments and start acting like a pro by building a disciplined, analytical process.
You know that feeling, right? The constant urge to check stock prices, the knot in your stomach when the market dips, and that temptation to just sell everything or buy into the latest hype based on a single news story.
Well, that kind of emotional, reactive investing, it's what separates the amateurs from the pros. It's behavior driven by fear and greed, not by a clear-headed system.
The pros, they don't do that. They have a system, a surveillance system. And today, we're going to show you exactly how it works, how you can use it to filter out all that chaos and focus on what actually matters.
So here's our game plan. First, we'll talk about escaping the noise. Then we'll dive into the three big pillars: the company's financial health, its strategic integrity, and the environment it operates in. And finally, we'll pull it all together into a plan you can actually use. All right, so first up, how do we escape this trap? The classic investor's dilemma. You know, that cycle of buying high when everyone's excited and selling low when panic sets in? Let's break it. See, the whole point here is to make a huge mindset shift. Instead of letting the market's mood swings toss you around, you anchor yourself to a solid, repeatable process. This is how you go from feeling anxious and out of control to feeling confident and in command. Okay, so let's get into the first pillar, financial health. I want you to think of this like you're giving the company a full-on medical checkup. We're going to check its vital signs to see if it's truly healthy. And the first vital sign we have to understand is the difference between what a company says it earned versus the actual cash it brought in. Net income, that's the accounting story. But free cash flow, or FCF, that's the real story. That's the actual cash hitting the bank account. A company can look profitable on paper but still go bankrupt if the cash isn't there.
And that brings us to this powerful little metric, the cash-quality ratio. Seriously, think of it as a truth detector for a company's profits. If this number is consistently above 1, it means those reported profits are backed by cold, hard cash. But if it dips below 1, well, that's a huge red flag that something might be off. All right, beyond just cash, here are the other vitals you gotta watch. The quick ratio tells you if they can pay their immediate bills, like tomorrow. Debt to equity shows you how much risk they're taking on, and return on equity, ROE, that's a big one. It basically tells you how good management is at turning your investment into more money. You want that to be high for sure. Okay, so the numbers look good. The company passed its physical. But, you know, a business is way more than just a spreadsheet, right? Now we need to understand the story behind those numbers. What makes this business special? And can it defend itself over the long haul? And the key concept here is something called a competitive moat. It's not a number you'll find on a report. It's a deep structural advantage. It's the reason a company can keep crushing it year after year. Think of it as the castle walls that keep all the competitors out. So what does a strong moat actually look like in the real world? Well, it could be a powerful brand that everybody knows and trusts, or a network effect, where the product gets better the more people use it. Maybe they own some killer tech, or they just make it a massive pain for customers to ever switch to a competitor. So who's in charge of building and defending this moat? The management team. And believe it or not, you can actually do a pretty good background check on them. You just have to read their annual 10K report, see if they're being candid, scour the risk factors section to see what really keeps them up at night, and definitely check to see if they get paid for long-term results, not just for hitting next quarter's numbers. Okay, so we've checked the company's health from the inside, and we've checked its defenses. Now it's time to zoom out and look at the world around it, because even the strongest castle can be affected by a huge storm it didn't see coming. A perfect example of this is something like interest rates. I know, they can seem a little abstract, but they have a very real, very direct impact on a company's health and its stock price. And here's why. Rising rates are a real double whammy. First, they make any debt more expensive, which can seriously squeeze profits. Second, they actually make a company's future profits worth less today, which can hammer its valuation. It's a nasty 1-2 punch, especially for high-growth companies. All right, let's put it all together, because having all this knowledge is fantastic, but it's pretty useless if you don't have a practical plan. This is where we turn all this theory into an actual, repeatable system you can use. So instead of obsessively checking your phone all day, you get into a professional rhythm. You can set up alerts for huge breaking news, sure, but your real work, your deep dives, happen quarterly when the companies release their official reports. Then, once a year, you do a big annual review and make sure your whole portfolio still makes sense for you.
And this is how you decide what to do. You buy when the fundamentals are strong and the valuation looks good. You hold as long as your original reason for investing is still valid. And here's the most important part. You only sell when that original investment thesis is fundamentally broken, not because the price dropped 10%. That is the key to discipline. So that's our explainer. And it all boils down to a pretty simple question. Is your next big decision going to be a reaction to a scary headline or a calm action based on your framework? By building a system, you don't just reduce stress, you create a powerful analytical edge. The choice is yours.